Our lesson today is Topic 2. Basic Accounting Concept. The contents are 2.1. Generally Accepted Accounting Principles, GAAP. 2.2. Accounting Concepts. 2.3. Accounting Equation. 2.4. Double Entry System. 2.1. The objective of Generally Accepted Accounting Principles, GAAP, are: the accounting profession has developed standards that are generally accepted and universally practiced. This common set of standards is called Generally Accepted Accounting Principles, GAAP. These standards indicate how to report economic events. The different opinions among accountants can be solved by referring to GAAP. It covers conventions, concepts, regulations, procedures, and the guidelines standards. It is important because the financial statements must be completed and easy to understand by others in order to make a comparison or to make any economic decision. 2.2. The accounting concepts are: historical cost, monetary measurement, economic entity, going concern, consistency, accounting period, materiality, revenue recognition, expense recognition, full disclosure, objectivity, and fair value measurement. The first concepts focus on the economic entity. The business is accounted for separately from other business entities, including its owner. Second concepts: monetary measurement. Express transactions and events in monetary, or money, units. Third concepts: going concern. Reflects assumption that the business will continue operating instead of being closed or sold. Fourth concepts: accounting period. The economic life of business can be divided into artificial time period for the purpose of financial reporting. Next, fifth concepts: revenue recognition. 1. Recognize revenue when it is earned. 2. Proceeds need not be in cash. 3. Measure revenue by cash received plus cash value of items received. Sixth concepts: expense recognition. Expenses are matched against revenues, and recorded in the same period in which the related revenues are earned. Seventh concepts: historical cost. Accounting information is based on actual cost. Eighth concepts: full disclosure. Report enough information for users to make knowledgeable decisions about the company. Next. Ninth concepts: consistency. Consistency means that a company uses the same accounting principles and methods from year to year. 10th concepts: objectivity. The financial statements of an organization be based on solid evidence. 11th concepts: materiality. Accountants are required to accurately account for significant items and transactions. 12th concepts: fair value measurement. Assets and liabilities should be reported at fair value when it comes to the point of selling assets or settling liabilities. The next slide will explain the sample situation and conclusion with the accounting concepts. 1. Historical cost. The acquired assets by a company should be recorded at their actual cost. The cost is a reliable measure and can be approved, and company should continue reporting the historical cost of an asset over its useful life. Example: the company purchases a car from supplier at a cost price of Rs 20,000 on August 21, 2016. The market value increases up to Rs 25,000 on the next day. Which amount should be recorded by the company? Why? Conclusion: the amount that should be recorded is the cost Rs 20,000 because this cost is a reliable measure. 2. Monetary measurement. Money is the common denominator in business. Monetary measurement is a principle that assumes business transactions or events can be measured and expressed in terms of monetary units, and they are stable and dependable. In other words, the language of business and finance is money. Expressing transactions and events in monetary units is crucial to the use of financial statements for business communications. Example of monetary units are the dollar in the United States or RM in Malaysia. Example: a transaction occurred in the organization but the value cannot be determined because of inflation. Conclusion: the transaction must be recorded in the monetary unit and the value assumed stable and did not change with the inflation situation. 3. Economic entity. The business and its owner are two different entities. The activities of the business must be kept separated and distinctively from the activities of the owner and of all other economic entities such as the creditors, suppliers, and customers. The entity needs to be evaluated separately from the owner, can hold properties and debts under its own name. Example: Sally Salat, owner of Sally's boutique, must keep her personal living costs separate from the expenses of the business. Whatever she took from the boutique must be declared as withdrawal or also known as drawings. 4. Going concern. The business will continue to operate long enough to carry out its existing objectives. It means that the entity will remain in operation for the foreseeable future. Most resources such as supplies, land, building, and equipment are acquired to be used rather than to sell. Example: the company purchases a car with a cost of Rm20,000 with the estimated useful life for 10 years. It is suggested that the car should be depreciated for 5 years because the business is expected to make a clearance in a short period. Conclusion: the suggestion is rejected because it contradicts with the going concern concept. The vehicle should be recorded at the value of Rm20,000 and must be depreciated for 10 years because the trade must be assumed to operate for the period that cannot be expected. 5. Consistency. Consistency means that a company uses the same accounting principles and methods from year to year. When financial information has been reported on a consistent basis, the financial statements permit meaningful analysis of trends within a company. Example: the company uses a straight-line method in depreciating the fixed asset of the company. The company decides to change to declining balance method. Conclusion: it does not comply with consistency concept because the method should be used from year to year. Any changes should be disclosed in the notes to the financial statements. 6. Accounting period. Time period covered by financial statements is known as accounting period. Time period assumption means business activities can be divided into specific periods such as a month, a quarter, and a year in order to enable comparison of business performance over time. Example: the company established on January 1, 2013. The trade closes the business account every 12 months at December 31 every year. Explain the concept involved. Conclusion: it is a normal condition when the trade follows the accounting period where the financial statements will be held every 12 months. 7. Materiality. Materiality relates to an item's impact on a firm's overall financial condition and operations. An item is material when it is likely to influence the decision of a reasonably prudent investor or creditor. To determine the materiality of an amount, the accountant usually compares it with such items as total assets, total liabilities, and net income. Example: a company purchases a calculator at cost Rm20 and it will depreciate for 5 years over its useful life. Give your opinion. Conclusion: although the proper accounting would depreciate the calculator over its useful life, but this cost is considered immaterial. It will not make a material difference on total assets and net income. So the cost of the calculator is best declared as a supply, current asset, rather than an equipment, fixed asset. 8. Revenue recognition. Revenue is recognized in the period they are earned. When the merchandise has arrived to the buyer or when services are rendered although cash has not been received. Criteria to recognize a revenue. There is a change of ownership or title. Buyers are willing to pay. The stability of the currency. Buyers are able to pay. Example: Ismail is a pottery entrepreneur. He has received reservations of porcelain vases on 1st of January, 2017 and has received a payment of Rm1000. The booking was sent on 1st of February. When is the sales for the 100 units of porcelain vase should be recognized? Give your opinion. Solution. ASML needs to recognize sales revenue of Rm 1000 on 1st of February. Because of the change of ownership on that date. 9. Expense recognition. Expenses are recorded in the accounting period in which it has been involved for a business revenue. Expenses are recognized when they are incurred even if payment has not yet been made. The goal: to find out the actual amount of revenue and expenditure for a financial period. Example: Tina has recorded expenses of Rm 2000 for utilities used in December 2016, although payment will only be made in January 2017. Is she doing the right thing? Explanation. Yes, Tina adheres to the concept of expense recognition, as an expense of the current period should be recorded in the current accounting period. 10. Full disclosure. The company should report the sufficient information, example relevant, reliable, comparable, so that the external parties can make a reasonable decision. Example: Farida Ent has made changes in stock valuation method used. The company did not disclose the information in the financial statements for the accounting period. Explanation. The situation does not comply with the concept of full disclosure, where a change made should be reported in the notes to the accounts. The aim is to inform the user of changes in the financial statements. 11. Objectivity. All accounting data should be valid and has reliable evidence to support transactions occurred. The goal: to prevent accountants in giving subjective and inaccurate opinion. Example: KZB company issues only receipt for cash transactions, but for the return of goods from sales transactions, no source document is issued. Give your opinion. Solution. The company does not comply with the concept of objectivity for the return of goods from sales transactions. For all transactions occurred which needs to be confirmed with the release of the source document. In addition to the evidence, it can also facilitate the recording. And last concept. 12. Fair value measurement. Fair value measurement states that assets and liabilities should be reported at fair value when it come to the point of selling assets or settling liabilities. Financial Accounting Standard Number 157 defines fair value as the price that would be received to sell an asset or paid to transfer a liability, the exit price, in an orderly transaction between market participants at the measurement date.